and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. It's the holiday season. Today, I wanted to make a list, check it twice. We're going to be talking about trading what's sometimes known as the Santa Rally using call options. So I want to talk about what the Santa Rally is and why some traders think that there tends to be a bit of bullishness here in the holiday season. And we're going to attempt to potentially take advantage of a move that happens in 2025, moving into 2026. Should be an interesting discussion, always for educational purposes only. But of course, as we get into this, let me first of all say hello to everyone who's already chatting in out there in YouTube. Great to see so many familiar names. Hello there, user and other user. We have the user character stream sequences. Hello to all of you. Selva, Kevin, Paul, Scott, Mighty Mouse, Option 66, JDLMI, Eva, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. I do see that there are a few usernames out there that I don't entirely recognize, so great to have you on board. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the presentation. Watching those recordings is a great way to watch these webcasts. But if you'd like to be here in the live presentation, this is a Tuesday webcast series, and we always kick things off promptly at noon Eastern. Now, as a special treat today, my very good longtime friend, Mike Fairborn, is going to be hanging out in the chats. He's going to be keeping an eye on your questions. And if I can't get to them, Mike's there to help pick up my slack. Thanks for having my back there, Mike. Mike, I also know that you're the right person to have in this discussion because I saw that you had also done a recent discussion of the Santa Rally. So let's show people where to find that. But Mike and I would like to issue an invitation to everybody listening. Please, as a service yourself, follow your favorite Schwab presenters on social media. You can find Mike and me on X. Find Mike there at Mike Fairborn CS. My handle on X is at Cameron May CS. And you can also follow me on LinkedIn. Just go to linkedin.com/in and then throw on /Cameron May CS, and that'll take you right to my profile. All right, but let's get into this discussion. Of course, as we do, there are risks associated with trading options, so bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only. It should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. All right, with that said, let's set an agenda for today's discussion. So I do want to take a quick look at some historical context regarding this late year move that some people refer to as the Santa Rally. What is the Santa Rally? Has it actually been a recent pattern on the markets? And if so, if it repeats itself again here in 2025, moving into 2026, is it something that might be tradable? We're going to be talking through current market conditions, how things are looking for a potential Santa Rally this year. We're going to be planning and placing an example trade today, and making sure that even the order gets entered. So we see the discussion of Santa Rally from start to finish, and the specific strategy we're going to be using is trading the Santa Rally with long call options. So let's go right to the Thinkorswim desktop. Rand Realty says, hi, brand new to options, not yet made a trade. Well, welcome aboard. I have a suggestion for you. If you're brand new to options, let me see if I can remember to point something out for you as a resource. But let's go to the S&P 500. Oh, actually, before I do this, we'll come back to the S&P 500 because I noted that Mike was helping me out in the chats. Mike recently did a webcast about this apparent market phenomenon known as the Santa Rally. So if you want to find previous webcasts of concluded discussions, what you can do, first of all, is make sure that you've subscribed to our Trader Talks channel on YouTube. It's called Trader Talks Schwab Coaching Webcasts. And you can join our live streams on that channel. You can also find the playlist for previous webcasts, or we can do a keyword search through those archives. So what I'm going to do is type in Santa, not Santa, but Santa. There we go. And right there at the top, Santa Claus rally just ahead. Key signals to watch is a discussion that Mike just had a few days ago. I think that'd be a great resource, great dovetail discussion for what we're going through today. But let's go back to the S&P 500. And I wanted to talk about what the Santa Rally is. Now, there are a number of potential definitions of the Santa Rally, but as the name sort of describes, it is an apparent bullish move on the markets, the rally portion of the title, associated with the holiday season, Santa Rally. Well, what's the typical length of the Santa Rally? Most commonly, it's described as being the last 5 days, trading days of the year, and the first 2 trading days of the next year. So it's right at the end of the year, moving into the next year. And if we look at how things are going as we're moving toward those dates right now, as of the recording of this discussion, I think there are 6 trading days left in 2025. I could go back and recount. I might be off by a day or two, if you'll forgive me. But in any case, it's been a nice week since we hit recent lows 1 week ago. And right up to the moment of this discussion, stocks have been climbing higher. But what I wanted to talk about is if there's an assumption that there's been a general historical trend for bullishness in the last 5 days of trading, let me ask you a question. Has that actually been the case on average over, let's say, the last 20 years? Has that been a recent phenomenon, or is it something mostly historical? And has that persisted into the first 2 or 3 days of trading of the next year? Now, those are the typical time frames. Just so you know, there are other traders who extend those backward and forward, both directions. Some people see the Santa Rally as being potentially longer than just 7 total trading days. But I wanted to get some historical context. Might be a little bit interesting. I'm going to switch up our chart style here, and we're going to look at a seasonality chart. So I'm going to change from a standard candle chart to a seasonality chart, which shows the green line is just sort of the normal chart. So this is what's happened this year. This is what happened last year, the red line. Well, that's only a 1-year history. Last year was actually a bit of a sell-off. No Santa Rally last year. Okay, see how things were going? See, does this look very similar to last year? Maybe a little bit earlier last year. But let's switch things up though. I'm going to switch this to a 20-year chart. And I'm going to zoom in. So this up here is still just year-to-date performance of the S&P 500. Down below is an average year of the last 20. So we take up all of the trading of the last 20 years. We spread that out according to what an average year has done over the last 20 years. And that's what we're looking at down here, but it's very compressed. So I need to zoom in on that. Let's come up here and change our Y-axis settings to a manual, which allows us to come down here and click and drag and zoom in on that time frame just down there. Greg says we must have been naughty last year. A lot of coal being dished out. Yep. Yeah. Drive and Dream says it was pretty flat. Yeah, flat on that compressed scale. This is actually what a typical year has been, an average year over the last 20 years. And we can look right here. This is basically the last week or so of trading on average over the last 20 years, including last year's disappointing performance for the bulls. So has there been historically this Santa Rally effect, at least for those last, let's say, week or so of trading, actually extending, a couple of days earlier than that? Yes, there has been a tendency. It's not a guarantee, though, that's going to happen in 2025. It didn't happen in 2024. But for some traders, they'll see this as a strong enough tendency to maybe provide a potential advantage, and maybe they're looking to benefit from that. Now, interestingly, on average, that momentum has not carried over into the first couple of days of trading the next year. So here, basically the first 2 days of trading on an average day over on an average year for the last 20 years. And there's been a little bit of a slip. But let's just take things from that traditional Santa Rally perspective and say, let's say that we're the hypothetical trader here, and we see, all right, let's assume that stocks are likely to go up for the next 5 days and maybe even 2 days into next year. And let's make a plan regarding that. Well, recognizing it's certainly not a guarantee. Let's switch our time frame back. It also doesn't always spread to every sector. There can be some sectors with stronger historical tendencies for strength in the last little bit of trading of the year. So I want to look at things from a sector perspective. Let me switch up my time frame again, though. Switch this to a 1-year daily chart. And how about we go, let's switch our style back. Sometimes I get ahead of myself. Go to the standard chart. So I was thinking one thing that we probably ought to address is, why does this effect happen? It could just be positive holiday sentiment. People are feeling optimistic, and I think that could be at least pretty. It's not a large logical step to convert optimism into bullishness. That's a possibility. Could it also be people spending their holiday bonuses or anticipating holiday bonuses and allocating those funds to the marketplace? Could be. Could it be people making last-minute retirement contributions, getting it in there under the deadline? That's a possibility. Could be any number of reasons, but those are some that have sort of been bandied about to explain what's going on here at the Jeff. It could be gains and losses on taxes. Yep, there could be a number of potential explanations, and sometimes all of that doesn't add up to bullishness like we saw in 2024. But there are some sectors that seem to have been historically stronger than others at this time of year. Couple of highlights might be technology. If everybody's feeling really bullish, really optimistic, and they're feeling particularly they have a particularly strong risk appetite and they're looking for growth, maybe they look to technology. Interestingly, another sector that typically has a nice run, not always, but historically a tendency, is consumer discretionary. People out there spending their money in the holidays. So let's go have a look. I wanted to have a look at the sectors. So I've actually loaded up a watch list of the S&P 500 sectors. Now, if you didn't know how I found this, you just go to your watch list tool in the left, go to the public watch lists, and we're going to look at what are called, this is Thinkorswim's title for it, the sector indices, but it's basically the sectors. Now, I've also added a custom column here by clicking on the gear, selecting Customize. I've added the description, which is basically the title of the sector. So I added that, and that allows us to see at a glance. Here's the energy sector, the materials sector, industrials. Right there is consumer discretionary. And I want to see how this is doing in this holiday season. How's it going for the Amazons and the Teslas? Yes, that's even that can be seen as a discretionary. You might think of it as an automaker, but hey, anyway, it's been a nice run up over the this is going all the way back to the third week of November, started a strong rally in discretionary. And that's largely in keeping with what might be assumed to be a typical sentiment this time of year, at least for 2025 to this point, starting that third week of November, things have been looking pretty good. So let's say that our hypothetical investor here sees maybe a strong seasonal tendency toward bullishness. Maybe they see a seasonal tendency toward particular bullishness in the consumer discretionary sector. Maybe they're zooming in on that for maybe placing their trade, and that's where I'm going to be trading our example call today. But I did want to introduce one more tool today, and that is the consumer discretionary has been having a nice run, but is it even better than what just the S&P has been experiencing itself? Well, there's a tool that might assist us in doing that comparison. For some traders, what they'll do when they're looking at a sector, they might compare it to see if it's relatively stronger than the S&P 500. Let's add our relative strength tool. There we go. So I'm going to choose relative strength. Let's add that to our chart. This is comparing our charted symbol, the sector, to the S&P 500. Which one is relatively stronger? As I click apply and click OK, when our blue line here is down, that means that our charted symbol, the sector of consumer discretionary in this case, is underperforming the S&P 500. If it's climbing, though, that's a period of outperforming. And you might notice the lows have started to get higher on the relative strength of the consumer discretionary sector. And we've even popped above an intermediate to longer term downward trend line, maybe starting into a new period of growth for consumer discretionary. So None of that adds up to a guarantee that what we're going to be demonstrating today is absolutely going to work. So we need to have a plan in place in case it doesn't. But let's go find a stock within this consumer discretionary sector. How can we very quickly see which stocks are in this S&P 500 sector? There's a tool right here on Thinkorswim that'll allow us to do that. We can go right here to Market Watch and choose the Visualize tool, also known as the Heat Map tool. And what this does is it shows the different sectors, information technology right here, consumer discretionary right there, and it draws a little box. If you'll notice, there are thicker margins surrounding the symbols contained within that sector. So I can glance right here and I see, hey, there's Amazon, which I mentioned earlier. There's Tesla, which I mentioned earlier. So yeah, there's a quick way that we can see which companies are in those sectors. And this is sort of color-coded to show us which one of those companies or which ones of those companies might be having the stronger days today and which are having the weaker days. So green indicates an up day. Red is a down day. Tesla's down 0.55% today. Amazon's up 1.2%. Let's go have a look at what's going on with Amazon. That's going to be our example trade today. So let's clean up our chart. Let's close out the relative strength. Let's bring up a chart of Amazon. And now Chuck is asking, Chuck, we don't talk about ETFs in this webcast. That's why I don't use them here. There's a very different set of governing rules for doing webcasts about ETFs and can't do it. Yep. So we use just the indices rather than related ETFs. Okay. But in any case, our Amazon, let's see what's going on with Amazon. What you'll see is we've been seeing higher lows on Amazon, but recent strengthening. Now, how long is the trader planning on being in a position right now? If we're looking at a traditional Santa rally, it's only 5 days plus 2. There might even be some that look at that seasonality chart and they say, forget it, I'm out in 5 days. Let's push this trade out 7 days. Now, with such a short time frame, we may want to give greater emphasis. Some technical traders will give a greater emphasis to what's actually happening on a very short time scale. So I'm going to come up here and change our time frame from a 1-year chart. Let's go to a custom time frame, even intraday. I'm going to look over just the last 20 days for our example here and look at hourly charts to observe things like trend and support and resistance and those kinds of things. So what's been happening on an hourly chart over the last about a week? Well, I think it's a little bit clearer to see now higher highs and higher lows on Amazon, and that's really continued in just the last few hours. Now, there's been a consolidation here. There was an apparent price ceiling stretching over, it looks like, Thursday, Friday, and Monday, where traders of Amazon looked like there was some hesitation to push through a ceiling somewhere around here. And then finally, just 2 hours ago, we pushed up and through that. So a trader might be taking a very short-term signal here on what's intended to be a short-term position and let's make a short-term plan for this. Now, if we were doing some more traditional technical analysis, we might be looking for maybe getting up to previous highs, maybe around 236.5, maybe even all the way to 239. It's interesting, that 239 level, if we do look at a longer term chart, let's go back to the 1 year for just a moment. There's our 239. That is a level that we've touched before. So for some, they might see that as an apparent price target. In this case, though, we're going to be planning our trade with a time target or a time exit. Instead of using price on a chart, we're just saying we're going to go with the historical tendency. Let's hope that 2025 is a little bit better than 2024 and more in keeping with those longer term tendencies. And let's say that our trader is planning to just buy a call on what they see as a stock that seems to be showing bullishness itself in a sector that seems to be showing bullishness itself and holding that through the Santa rally period. That's going to be the logic of this trade rather than exclusively going off what we see on our chart although it might still be helpful for a trader when they're looking at that. Let's go back to that intraday, 20 days, 20-minute. This is the actual sort of technical, not 20-minute. Oops. I wanted to go to the 20-day, 1 hour. There we are. Clean that up a little bit. There we are. All right. Yeah, and that's interesting that it is even continuing to strengthen as I'm talking. That's not a guarantee that this trade is definitely going to work out, but it's nice that it's behaving in a bullish way as we're talking about it. So here's going to be the plan for our trade. For some traders, if for a stock trader, maybe they just buy the stock. They might buy it 5-6 days before the end of the year, and then plan to sell on the second day of the year. What day is that, by the way? How can we tell? You can bring up a calendar. One thing you can do on Thinkorswim, now that we have our idea for our trade here, I'm going to go to a 1-year chart, and what you'll notice is that I've extended this. I've added an expansion to the right, 19 bars. Let's round it off to just nice round 20 bars. That means there's an extra 20 days of space here on our chart, and I can see there's 2025. So we're transitioning. The holidays need to be accounted for. So the markets are closed, pardon me, closed on the holidays. But we can see here's January 1st. That's not a trading day. There's the 2nd. There's our first trading day. Then there's a weekend, and the 5th is our second trading day. So yeah, even if we wanted to close out before that weekend, and maybe for some long call buyers or long options traders, they might want to, because what happens over the weekend? When stocks, when options are not trading, time decay, still chipping away. Now we're going to try to minimize that, even though we're planning on getting out on the 5th, and that's when we're going to exit this trade. Let's go out here and buy a 16th of January contract to add some additional time to these so that we're not just running right up on the edge of time and seeing the full impact of time decay. Let's pop this out to, yeah, theta. Cecil is exactly right, chipping away over that longer, it's not a longer weekend, it's a normal weekend. But in any case, for that reason, some might sell like on the 2nd instead of the 5th. I'm going to do the 5th. So let's buy a January 16th. That's giving us enough time to get through the holiday. If we go longer, trader could go longer. Those contracts are just more expensive, but they'll have slower time decay. If we go shorter, what could we, if we wanted to get, there's the 2nd of January. We could choose like a weekly, the 9th of January. A couple of different issues with those. The weeklies tend to have wider spreads between the bid and the ask price. They tend to be less liquid, not quite as well priced, but also stronger time decay impact. So lower cost, more theta, wider spreads, they're trade-offs. So option 66 says, can you show how to extend the right side of the chart again? I definitely can. And by the way, if you ever need to revisit any of the concepts that I've discussed in this webcast, what you might want to do is go to our channel after the webcast is over. We try to get these posted pretty promptly, and then you can just check the archive and go to the moment where I covered that and just revisit how things are done. But yeah, we can go to the charts. So if there's no white space, let me clean it up. It's actually using, see the little double-headed arrow icon down here? Those are the expansion settings. So I can change those to show, let's say, no bars. If we apply that, you can see that the last candle gets crushed right up against the right margin. Or we can add 10 or 20 or whatever. I'll just do, and it doesn't even have to be round numbers. It could be 14 or 22. Let me click OK. That's how it's done. So let's go to our trade tab, and I'm going to be placing a trade with an exit planned, not based on what the stock price does, but on what time does to us. Okay, Shrikant says, we don't know how what the whole future holds, but if history repeat, you can see it potentially rallying again. Well, that's, yep, exactly the premise for our hypothetical trader today. So next up, The trader is making a decision. We've selected the strike price. We have the stock selected. What about the expiration? Or, pardon me, we have our expiration. What about the strike price? I said we've selected the strike price. We haven't selected the strike price. That's what we're doing right now. Well, we can buy a more expensive contract or a less expensive contract. Going in the money becomes pricier, but it allows the trader theoretically to buy shares at a lower price. That's the terms of the contract. We can go out of the money, which is a contractual right to buy shares at higher prices, but it costs us less. Now, there's an interesting thing that a trader should know about these in the money versus the out of the money contracts, and that is in the money contracts, since they're more expensive, they're less leveraged. The ones that are out of the money, less expensive, more leveraged, for better or worse, because leverage can work in either direction. But let's just say that our trader's relatively confident that Amazon and the markets are going to have this nice run into the last part of the year and in the first couple of days of the next year. And so they want a little additional leverage. So rather than going in the money here, what if we were to buy, let's see, our shares are trading at 231 and change. How about we buy the 232, slightly out of the money contracts? Looks like those are trading about 555 to 560. If Amazon were to go up a single dollar very quickly, how much would that make theoretically for this trade? We buy this for about $5.50. The stock pops up $1. We might look over here at Delta, and that would project about a 50-cent return on our 550 investment. A $1 move on our stock, if we're right about our rally, that might produce about a 10% return on our option. Yeah, that can show you the degree of initial leverage of this trade, and that's pretty strong. That's quite a degree of leverage. Obviously, if the stock were to fall, we could lose about 10% of the value of this investment. That's why the timing is so key when trading long call options. All right, but let's do this one. Let's buy that 555. Looks like 555 to 565. How many contracts should we buy? This is where the trader needs to do a little calculation. Let's say that we're able to buy this for $5.60 per share. And if it's helpful for those that are new to options trading, here's the example trade. Let me spell this out in fairly explicit language so we can know exactly what we're doing here. So our example trade is what's known as a long call, or we're buying a call. Okay? We're going to buy the 16th of January, and we were just looking at the 232.5 call. And it looks like that's trading, might be able to get that. Let's just say it costs us $5.65. All right? So here's what we're doing, spending $5.65 per share. These are standard contracts, which means that they're giving us the contractual right to buy 100 shares of stock at any time between now and the 16th of January, or in other words, anytime in the next 24 days, we have the right to buy shares for $232.50. If there's a strong Santa rally in a stock, let's say it blasts off and it goes up to 239 like we thought it was going to, and we did it, well, and that's just going back to that chart, the high candle that we saw. Let's say that we rapidly move up to 239. Well, we'd have the right to buy shares for 232.5. That would be at least a $6.50 value plus whatever remaining time value there is in the contract. But that's the deal. We have the right to buy shares at any time for the next 24 days for $232.5. Now, our intention is not to do that, though. What we're actually hoping to do is buy the calls, see the value of those calls increase, and then sell those calls. Selva's asking about implied volatility. I've noticed a number of questions about implied volatility in recent webcasts. Implied volatility can be important. It's getting a little bit deep in the weeds for this discussion. I wanted to keep it a little bit higher level, but there is a strong correlation between volatility and options prices. When volatility is high, options prices tend to also be higher than other times. That's because volatility, if it goes, well, volatility to an options trader can just represent potential. Buying a call on a stock that's not moving, that's extremely stable, that's boring, probably not going to make any money. Buying a call on a stock that's just moving all over the place, if our timing is great, ooh, that's a lot of potential, but it also carries lots of risk. So the mere fact that implied volatility happens to be, high or low is neither inherently good nor bad. It just implies that the stock is likely to be more volatile. Volatility, again, neither good nor bad. It just means be prepared for volatility. So yes, we could check that. I'm not going to do it for today's discussion, but you could write down here. Now, what the heck? We'll check it. We can go to today's option statistics, and we can see the range of volatility has been between 26 and 67. And right now, our implied volatility is about 30. So much closer to the low end of that range than the high end. So what that two conclusions there that might be made is that options premiums are probably lower on Amazon than at other times. So this is probably less money than we would typically have to pay for a $24 contract. But also, it's kind of a quiet period for Amazon. That's it. All right, so the quiet period could change in a heartbeat, though. We all know that. Anyway, let's plan our trade. We're going to buy the 232.5, spend the $565. This is where the trader might calculate how many contracts they might want to buy. Let's say that our trader here has a couple $1,000s to spend. Maybe they decide to buy 4 contracts. 565 times 4 is going to be a little bit more than 2,000. Maybe 20. What's it going to be? 2260. Anyway, that was a very quick calculation. I'll be amazed if I was right. Anyway, let's see. 65 times 2 is 130. Yeah, 2260. Anyway, when are we going to sell? Well, whether this trade works or not, we're going to sell on the 5th. That's going to be the plan. So we're going to ride out whatever comes. Now, for some traders, they might not be thrilled with that idea, because some traders will decide, well, if I'm going to spend 565, I'm going to risk a certain fraction of that, a percentage of that, and insert a stop. Or if it increases by a certain percentage, I'm going to have a target in place. We're going to let the markets bring what the markets bring and exit on the 5th and see what Santa has in store for us. It might be there might be stocking full of goodies. It could be another lump of coal like 2024. So it says, why do a bull call spread versus a bull put spread? Another good question, way off topic for this discussion, so I'm not going to go deeply into that. However, I have in the past, though. What you're really asking about is a credit spread versus a debit spread. Well, let me show you how to find out a good answer to that question. Go to our YouTube channel, and right here where we previously did a search for Santa, just change that to credit, debit. And what do you know? Here's a discussion or a webcast that I dedicated to what I call the Options Vertical Showdown. Trade a credit or a debit spread. Check that webcast out. I think that's going to have some really interesting insights for you. But in any case, there's our plan. Let's buy this contract. Has it changed on us already? A little bit less expensive right now, a little bit lower in price. We've come down maybe 10 cents. So we might be able to buy this for $555-ish. But let's attach a time exit to this, getting a little bit fancy. So here's how we might do that. I'm going to click on this to start buying a call. We're going to do 4 calls. Keep it around $2,300. So let's put it in order to buy 4. And with our natural around 555, let's say that's going to be our limit order. So I'm going to click on the little lock. That locks in this as the most we're willing to spend. And let's leave that a day order. But I'm going to right click on this. Well, actually, first of all, we need to change our advanced order type to a first triggers sequential order. If this first order fills, a sequential or second order will go into effect. So here's that second order. Right click, create an opposite order. This is to close out our trade. But when are we going to close it out? We're going to close it out near the end of business on the 5th. So that's going to be an order condition, which is accessed using our little gear over here to the right. So let's put in that condition. We're going to submit an order on January 5th and let's put this at, this is going to be my local time, right? Right now, I'm in the mountains of Utah. It's about 10:35 right now. Markets close here at 2 o'clock. So I'm going to change this to about 1:35. Actually, that would be, I need to make this sort of what I would call military time. In any case, 13:35, okay? That's going to be 1 o'clock in the afternoon. So what do we want to have happen at 1 o'clock in the afternoon on the 5th? We want to sell this call. Now, the thing is, I don't know how much it's going to be worth at that time, so I'm going to change this to a market order. And that's going to be our trade, okay? So let's click save. What we're doing here, putting in an order on the 5th at 1:30, 25 minutes before the close, to sell our call at the market price, whatever it's worth at that time. So if it's profitable, great. If it's unprofitable, not so great, but that's also another potential outcome. Let me click save, and let's confirm and send this order. Buying 4 contracts, so the 232.5 calls, we're going to try to get those for 555. I don't know if those will fill or not, because if they're not available for 555, they won't fill. If they are, then we might even buy them at a lower price. Going to sell those at the market, but that order is going to be submitted on the 5th of January, 1 o'clock, 1:34:47. You notice I didn't bother to round that off to exactly the minute. It's not really, we don't know exactly what the prices are going to be at that time. So we can round it off if we want to. It theoretically doesn't make a huge difference. Anyway, there is a commission to be paid to get into this trade and to get out of it if the order fills to get in. And then we'd send that order off. Now this webcast, I'm not going to send the order. I just wanted to talk through the process. But guys, we've accomplished what we set out to do today. We have talked about the history of the Santa rally. We've actually examined it. Has it been the case over the last 20 years on average? Then we planned and placed an example trade using a long call in an effort to exploit or take advantage of any emerging Santa rally for this year. Now we recognize there might not be a rally, so come the 5th, we would just get what we can out of that call. So Chaz says, can you put in 2 conditions at the same time? Yes, we can. Yep. We do that in other webcasts. We just didn't do that today. Let's see. Jeff says if the expected movement is about 1275 by January 24th, we'd assume we expect. Sorry, Jeff, I can't quite make out what you're asking there. My apologies. I'm sure I'm just misreading it. But in any case, guys, time for me to let you go. But this is what we do with these Tuesday webcasts. We just talk through getting started with options and try to give that some context regarding current market conditions. So I hope you enjoyed this discussion. I will look for you in a future webcast, but I want to make you aware of resources that are available to you outside of these live stream discussions, starting with a final reminder. If you haven't done it already, make sure that you're subscribed to our Trader Talks channel on YouTube. You just click on the subscribe button down below the video. It only takes a moment, doesn't cost anything, but this is where you can join our live streams. You can find playlists of previous webcasts. You can even do keyword searches through the archives, just as we've done a couple of times in this webcast. Now, another thing that Mike and I would suggest that you do is to follow us on social media. You can find Mike and me on X. You can find Mike on X at Mike Fairborn CS. You can find me on X at Cameron May CS. And if you reply to one of my posts here, I try to reply right back to you. So for example, I just posted this morning about something known as a breakaway gap with an apparent recent example on Paramount. Little pop up there. You'll see me discuss that, talk about how the breakaway gap works. And you can also follow me on LinkedIn. Just go to linkedin.com/in, and then add my handle /Cameron May CS. That'll take you right to my profile. You can give me a follow here. This has only been available. I've only been on LinkedIn for weeks at this point. So I I also post here. I do longer posts here, which is nice because we don't have the character limit that we have on X. But if you reply to my posts here, I try to reply right back to you. All right, everybody. Thanks for joining me today. I do want to wish you happy holidays. I will not have any more webcasts before Christmas, so I won't see you before then. So I hope everybody has a great holiday. Mike, thanks for helping out in chat. Everybody, thanks for all the thumbs up. I can see 138 people watching the live stream right now, and it looks like, as I refresh my screen here, 45 have already clicked the like button. That's very much appreciated. That's like a pat on the back to your presenter. It also gives my webcast a nice little boost in the YouTube algorithm, helps more people find these webcasts. So thanks for doing it. I will see you in a future webcast. I'll also look for you on social media, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.